Agnico Eagle Q4 2025 Summary Highlights. Despite the record results, some pressure points remain. 2026 Cost Guidance Disappointment. Total cash costs are expected to rise to between $1,020 and $1,120 per ounce in 2026, a 12% year-over-year increase that triggered a negative market reaction. Sticky inflation. Labor costs, 45% of the cost base, are inflating at 4%, while consumables like fuel and reagents are seeing increases of 5.5% to 6%. Capital intensity. Sustaining and development capital is expected to remain high at $2.4 billion to $2.5 billion annually through 2030, creating execution risk for simultaneous projects. Higher cost marginal ounces. Pursuing higher-cost mine life expansions like Meadowbank at $2,200 to $2,300 per ounce AISC reduces the margin of safety if gold prices retreat. Agnico Eagle's 2025 performance highlights several structural advantages. Robust cash flow and balance sheet. Generation of $4.4 billion in annual free cash flow has allowed the company to eliminate nearly all net debt. This provides the flexibility to fund a $5 billion to $6 billion growth program through 2030 internally. Tier 1 Jurisdiction Premium. By focusing on Canada, Australia, and Finland, the company avoids the jurisdiction discount applied to peers in volatile regions. Agnico Eagle is regarded as a safe haven play. Reliable management. Meeting production guidance for the 33rd consecutive year reinforces a reputation for operational continuity and reliability. Per-share focused growth. The focus on organic growth through existing assets avoids shareholder dilution from premium-heavy M&A.
Agnico Eagle Q4 2025 Deep Dive. The fiscal year 2025 represented a landmark period for Agnico Eagle Mines Limited, marking the definitive transition from a post-merger integration phase into a multi-decade organic growth trajectory. By delivering record-breaking financial results against a backdrop of historic gold price appreciation, the company has solidified its position as the premier low-risk vehicle for precious metals exposure. The financial results for the year ended December 31, 2025, were defined by an expansion of margins and the capture of significant commodity upside. Agnico Eagle reported a total annual revenue from mining operations of approximately $11.91 billion, representing a 44.2% increase over the $8.26 billion generated in 2024. This revenue growth was achieved despite a marginal decrease in total payable gold production, illustrating the immense leverage the company maintains to the realized gold price. For the full year 2025, net income surged to $4.46 billion, $8.89 per share, which represents a 135% increase compared to the $1.90 billion, $3.79 per share, reported in 2024. On an adjusted basis, which excludes non-recurring items and non-cash valuation adjustments, the company generated record annual earnings of $4.17 billion, or $8.31 per share. This financial prowess was particularly evident in the fourth quarter, where the company realized an average gold price of $4,163 per ounce, facilitating a quarterly net income of $1.52 billion. The company's ability to convert high gold prices into free cash flow reached unprecedented levels. Annual cash provided by operating activities reached a record $6.82 billion, while free cash flow reached a record $4.4 billion. This cash flow generation allowed Agnico Eagle to achieve several key strategic objectives simultaneously: aggressive debt repayment, significant shareholder returns, and the acceleration of a high-value project pipeline.
The strengthening of the balance sheet was a central pillar of the 2025 narrative. Agnico Eagle repaid approximately $950 million in debt during the year, effectively cleaning up its near-term maturity profile. This included the redemption of senior notes with coupons ranging from 4.38% to 4.94%, significantly lowering the company's ongoing interest expense. By the end of 2025, the company reported a cash balance of $2.87 billion, up from $916 million at the end of 2024. The net debt position was reduced to approximately $196.3 million in long-term debt, against a cash cushion of nearly $2.9 billion, placing the company in its strongest ever financial position. This liquidity is critical as the company prepares for a $1.3 billion cash tax payment in February 2026, related to its record-breaking 2025 earnings. In 2025, Agnico Eagle's operational performance was characterized by consistency across its three main business segments: Northern Business, Southern Business, and Australian operations. Total payable gold production for the year was 3,447,367 ounces, which comfortably reached the midpoint of the company's initial guidance range of 3.3 to 3.5 million ounces. However, the cost environment remains a subject of intense scrutiny. For the full year 2025, total cash costs per ounce were $979, and all-in sustaining costs, AISC, were $1,339 per ounce. Both metrics were slightly above the top end of the 2025 guidance ranges of $915 to $965 and $1,250 to $1,300, respectively. The primary driver for this variance was the impact of higher royalties resulting from the surge in realized gold prices. The company's original guidance assumed a gold price of $2,500 per ounce, whereas the actual realized price of $3,454 added approximately $42 per ounce in incremental royalty costs. Excluding these royalties, the total cash costs would have been $937 per ounce, below the midpoint of the original guidance range. The fourth quarter specifically saw higher unit costs due to a combination of lower production volumes, 840,608 ounces compared to 847,401 in Q4 2024, and accelerated spending at the Meadowbank operation to facilitate a mine life extension. Management has emphasized that while total costs are rising, the cost per dollar of revenue has actually improved, as the company captured over 95% of the gold price increase for the benefit of shareholders.
The Northern Business segment, primarily located in Canada and Finland, remains the engine of Agnico Eagle's production and cash flow. In the Abitibi region, the LaRonde Complex and Canadian Malartic were highlighted for operational excellence. LaRonde continues to navigate increased seismicity at depth through sophisticated mining sequences, integrating the Fringe, Dumagami, and 11-3 zones to enhance production flexibility. In 2026, LaRonde is expected to increase production to approximately 340,000 ounces, driven by higher grades and a mining rate increase at LaRonde Zone 5, LZ5, to 3,800 TPD, which is a year earlier than previously anticipated. Canadian Malartic, the largest operating gold mine in the world in terms of total material moved, is currently undergoing a massive transition from the Barnat open pit to the Odyssey underground mine. The operation outperformed expectations in 2025 due to better-than-planned grades at Barnat. The Odyssey mine ramped up significantly, with the first production from the East Gouldie deposit expected in the first quarter of 2026. In Nunavut, Meliadine and Meadowbank delivered strong operational results, though Meliadine faces slight production headwinds in 2026 due to mine plan adjustments following significant cost improvement initiatives. Meadowbank, conversely, saw a material improvement in its outlook. Supported by the elevated gold price environment, the company approved an open-pit pushback that extends the mine life by 2 years to 2030. These additional 740,000 ounces, while carrying a higher AISC of $2,200 to $2,300 per ounce, provide low-risk cash flow by utilizing existing infrastructure. Fosterville in Australia and Kittilä in Finland represent high-margin, technically specialized operations. Fosterville demonstrated geological resilience by replacing 101% of its mining depletion in 2025, adding 170,000 ounces to reserves, primarily through exploration at Robbins Hill and South Phoenix. Despite expected natural grade declines as the high-grade Swan Zone is depleted, Fosterville is initiating plans to offset this through higher throughput and operational optimization. Kittilä produced 217,379 ounces in 2025 at a total cash cost of $1,087 per ounce. The operation is unique within the portfolio due to its pressure oxidation (POX) circuit, which is required to process its refractory ore. Kittilä's outlook for 2026 and beyond has improved, with higher production expected to offset temporary sequencing delays at other assets. Agnico Eagle has unveiled a strategic blueprint to increase its annual production by 20% to 30% over the next decade, targeting a sustainable output of over 4 million ounces by the early 2030s. This growth is distinguished by its organic nature. It is derived from assets the company already owns, in jurisdictions it knows well, thereby minimizing execution and geopolitical risks. The most significant component of this plan is the transformation of Detour Lake into a premier million-ounce gold producer. The company is tripling its investment in the Detour Lake Underground project to $300 million through mid-2027 to accelerate development. At the Canadian Malartic Complex, the Fill the Mill strategy is designed to utilize excess capacity of the 60,000 TPD facility, potentially adding 400,000 to 500,000 ounces of annual production. The foundation of Agnico Eagle's multi-decade vision is its industry-leading exploration program. In 2025, the company completed nearly 1.4 million meters of diamond drilling, the largest budget in its history. Total gold mineral reserves increased by 2.1% to reach a record 55.4 million ounces. This increase is notable as it occurred after mining 3 million ounces, implying a reserve replacement rate of approximately 135%. Significant resource breakthroughs in 2025 included the Detour Lake Underground, where indicated resources rose to 3.47 million ounces, and Odyssey, East Gouldie, where inferred resources grew by 62% to 7.4 million ounces. Conclusion: Agnico Eagle Mines Limited's 2025 performance was a tour de force of operational execution. By utilizing a period of record gold prices to delever its balance sheet and build cash reserves, the company has funded a transformational organic growth pipeline. While 2026 cost guidance highlights inflationary challenges, the ability to replace 135% of reserves suggests the company's geological engine remains strong. Project execution across multiple simultaneous expansions will be the primary risk to monitor in the coming decade.